So today we're going to be talking about equity. We're going to talk about how you can access your equity. We're going to give you some examples, and we're going to talk about some of the things that you could be able to do with your equity. The first thing that we're going to start to talk about is what is equity. And so equity is the difference between how much you owe on your home and the value of your home. So in this situation, we have a value of $500,000. We have a balance of $200,000. We subtract 200 from 500, and we have 300,000. So that is the equity that an individual would have in their home in this situation. If you have multiple loans, let's say there's an additional loan of 50,000, so we'd have a balance of 200 on the first mortgage, 50,000 on a Heloc or a second mortgage. That would give us $250,000 in equity. So you're going to subtract your liabilities that you have against your home. How to access your equity. There's a few different products that you can be able to access it with. You could look at a refinance of your mortgage that you have right now and obtain cash. You can leave your mortgage that you currently have in place and get a second mortgage that's behind your first mortgage. It's called the second mortgage because it's in second lien position. That would allow that first mortgage to remain as it is right now. Sometimes people like to utilize that second mortgage product because they have a really, really good rate on their first, or they don't want to touch that first loan. We have second mortgages so that we can be able to stay away from that. We have Helocs, which is just like a second mortgage, but it's a line of credit. It's a different type of second mortgage from a fixed rate term loan. And then there's reverse mortgage options. There are age requirements on the reverse mortgage. If anybody has any questions on the reverse mortgage, I am a reverse mortgage expert specialist. You can be able to ask questions about those. We won't dive too much into those, but that is something that you can be able to use to access equity. Okay, a lot of times people ask why they want to tap into their equity. I find that when people say that they're tapping into their equity, they feel like they're sometimes doing something wrong, or they are spending erroneously, and that is just not the case. There's many reasons why somebody would want to tap into the equity of their home. A lot of times it's really just simplifying or streamlining your finances. Every time that I sit down and talk with somebody, I want to find out what the primary goal is, what they're trying to accomplish. The reason I like to do that is because goals can change over time. They can change in a very short period of time. The conversations that I were having with people in the fall of 2019 and the spring of 2020 were vastly different with what was going on. There's life events that take place regardless of what's going on in the world. We've got weddings, college, growing families, upgrading, home maintenance, building wealth, buying a second home, emergency preparedness. We put emergency preparedness on that when we initially started talking about this stuff in 2018. Lord knows how much more important that's become. Sometimes people will want to open up a Heloc, even a home equity line of credit, even if they aren't needing any funds at the present moment, in case of an emergency. Sometimes people like to use the home equity lines of credit for business cash flow in the event that they need to access a large sum of money in a short period of time. They have that available. Helocs also can be beneficial for future needs or short-term needs. The benefit of a Heloc is that you can be able to borrow the money and pay it back and reborrow the money. It's essentially like a credit card that's attached to your home. And so when you use your Heloc, you can be able to get that money in and out quickly. So if you needed to borrow a certain amount of funds in a situation, let's say that you wanted to pay cash to get your windows replaced or something like that because it was cheaper, you could be able to do that. Those funds you could withdraw them, be able to pay for that, and then you could be able to repay that with another type of loan product or take a certain amount of time to be able to get that paid off. You also could be able to start on one track and then move to something else because it's something else that you want to do or want to restructure the finances. So there's a lot of ways that Heloc can be flexible for you and be a tool that you can be able to use to be able to help you out. Second mortgages, the difference between a second mortgage and a home equity line of credit. Home equity lines of credit here at the credit union have variable rates. A second mortgage, they are fixed rates and they're term loans. You select what you would like your term to be at the beginning. There's going to be a coinciding rate depending on how long that term is going to be and what your credit score is and what your loan to value is. We know that the payment is going to be X every single month, and at the end of the term, whatever you select, let's say in this situation you select a 5-year term, in 60 months that balance is going to be paid to zero. Home equity lines of credit are not set up that way. Here at the credit union, we have interest-only options or a 1% repayment. So if you were to borrow $100,000 at 1%, your payment would be $1,000 each individual month. As you pay that loan down, your payment is going to shrink. So there's really not a term where I know that I'm going to have that loan paid off in X amount of months. So the Heloc products and the second rate fixed mortgages are just different, and we can be able to talk to you about what's going to be best for you at this current moment and what you're trying to accomplish. A lot of times people will use the equity in their home for debt consolidation. So we're going to go through an example of an individual that we helped recently and what they did and how we were able to help them. So this individual bought a home in February of 2020. They bought it for $238,000, and their original loan was for $230,000. They currently have an FHA loan. An FHA loan is going to have mortgage insurance on it that we know of. The balance on it was $220,000. It looks like I made some changes to this, and it looks like I didn't change all the things that I had there. So the individual has used over the past 3 months, they have remodeled and used some of their credit cards, and so this is their current debt that they have on there. If you go back right there, so they have their mortgage. They've got a Chase card with $4,000 on it. You can see the coinciding rate and payment. They've got an Amex card. They've got a Disney Visa card, and they've got a Home Depot card. And so we look at the total payments that they have each individual month are $1,850. So the member was also asking for an additional $15,000 to finish remodeling the main floor and the bathrooms. So when we go through the total cost of their model, they're going to be paying over the lifetime of the loan, the credit card interest that they're going to be paying. We look at what the total cost is going to be if they stay with their current format that they have with their finances. We looked at this and we knew right away that we could be able to make some changes, some subtle changes, so that they could be able to accomplish their goals and really restructure their finances. So here were the solutions that we had for them. We looked at a 20-year rate and a 20-year loan and a 30-year loan. We looked at the 20-year loan with a rate of 3%. The new loan amount was $260,000. The new payment was $1,740. We were able to remove the mortgage insurance because of the value of the home had increased. The total their primary goal that they wanted to accomplish. They needed $15,000 to be able to finish their remodel. So that was the primary goal. What we were able to do is take all the information that they had that we had in front of them and be able to come up with a more comprehensive plan to be able to help them with their finances. We also gave them a 30-year loan option, went through that with them. In this situation, they looked at everything and we were able to check more boxes off with the 20-year loan than the 30-year loan. So that was the option that we went with. When we ask people what their primary goal is, it's important that we find out what that is. And the reason it's important is because we can be able to we can structure everything around that. Once we find out what the primary goal is, if there's a secondary goal, if there's a tertiary goal, we can be able to try and accomplish those as well. But usually that primary goal is going to be the ultimate focus of what we're trying to do, and we can be able to find a good product for people within that parameter. Okay, any questions that anybody has? I'll give you just a minute to pop any questions that might be up there. Yeah, so a couple things while people are, see a couple people typing right now. So a couple things that are important to think about when you're accessing the equity in your home is that the median house price in Salt Lake County for a single family home in July of 2021 was $551,000, and that was according to the Salt Lake Tribune. When we think about things that people want to do with the equity in their home, it's really endless on what they can be able to do. But there's also some things with the increase in values that could be able to be beneficial. We talked about this one with the individual removing their mortgage insurance. If you know anybody who's paying mortgage insurance right now, they should have a conversation with a mortgage consultant to see if there's something that we could be able to do about that. There has been tremendous amount of growth in the last 5 years. I was talking to a local realtor the other day. He told me that in Sandy alone in the last 5 years, home prices have gone up 106%. That gives a lot of flexibility for people to be able to do things with their homes that they really couldn't be able to do before. The life expectancy of a home is only so many years. There's a lot of things that need to be done in a lot of homes. They're very expensive things. We can use the equity in your home in a variety of different ways to be able to streamline that so that we can be able to help you with what you're trying to accomplish. Whatever your goals are, just let us know, and we can be able to try and fit something that works for you. Most of the time when we sit down and have a conversation with somebody, they're surprised at how well we can be able to restructure their finances to be able to put them in a better financial position. Okay, one of the questions, can you talk more about the pros and the cons of a HELOC versus a second mortgage? Absolutely. So I do tell people I'm a little bit more, I'm biased towards the home equity lines of credit. I'm much more of a fan of going with a fixed rate mortgage. I'm a more conservative individual financially. And the reason I'm a proponent of going with the second rate mortgages is because it is a fixed rate and we have a term where we know we're going to be paid to a zero balance. So here are the pros of the HELOC though. The credit union has an introductory rate on the home equity lines of credit. I believe that's at 1.74%. I think that's where we're at right now. So there is an introductory rate where you can be able to save a tremendous amount of money in the short term. Another pro for the HELOC is that if you get the HELOC initially, you're not paying any interest until you borrow on that amount of money. So you can be able to have a 0%, or excuse me, you can have a zero balance and not be paying any interest for 1, 2, 3 years and just have that there if you want to. Those are some pros that you have with the HELOC. Another pro is that they do have the interest-only payment. The payments can be smaller on the amount. So in a situation that I helped with somebody recently, they knew they were going to be selling their home. They wanted to borrow about $45,000 to remodel their home before they got it ready to sell. The home equity line of credit seemed to be the best option for them because they were worried about their finances and what they were doing month to month. So they were able to borrow the money. They were able to have a much lower payment, and then they were able to upgrade the home and then sell it and pay the HELOC off. So in some situations, the HELOC is going to be a tremendous product that you can be able to use. In other situations, I think that the second mortgage is going to be beneficial for you. So the second mortgage, the pros of the second mortgage is that you are on a fixed rate, you've got a term. So if I know I'm borrowing $40,000, I've got a certain rate, I've got a certain term, it's going to calculate a payment for me each individual month. I'm going to pay that every month and it's going to eventually be at a zero balance. The cons of the second mortgages compared to the HELOCs is right now, the HELOCs have better rates. And the first mortgages have better rates than the HELOCs as well. So we haven't been doing a tremendous amount of second mortgages. I think we've only done 2. Excuse me, I've only done 2 in the past couple of years. And the reason is because other options have just been better for people. But we can be able to go through all of those and find out what's going to be better for you. Joseph, if you have any follow-up questions on that one, just let me know and I can be able to touch base on those. Can I use the funds for anything? You can be able to use the funds for anything. We're qualifying you on the amount that you're looking to borrow. There are times where we may need to qualify you by paying off specific debts, and we will need to pay those at closing, and we'll take care of that for you. But we don't dictate where the funds are going to be used for unless it's in that situation. So if you'd like to use the funds, we'd borrow $40,000 and use 30 of it to fix your home and $10,000 to do something else with, you're more than welcome to be able to do that. There'll be no scrutiny from us on that. Another question, can you go back and discuss the refi, please? I believe that's a refinance. Yeah, I can discuss a little bit more. If you got any follow-up questions or want me to discuss something specific, let me know on that one. So with a refinance, like a cash out refinance in this situation, an individual had equity in their home to be able to pull cash out. We can do a cash out refinance up to 80% of the value of the home. So if the value of the home is $500,000 on a cash out refinance, we can only go up to $400,000 or 80% of that value. The home equity line of credit and the second mortgage allow us to go higher than that. So sometimes those products can be more beneficial depending on where the loan to value is. So in this situation, we were able to take their finances because the equity that was available and consolidate those mortgages, or excuse me, those debts into the mortgage. For easy numbers, when somebody finances $1,000 on a car, it's roughly $20 a month. When you finance $1,000 on a mortgage, it's roughly $5 a month. So when we're going through and we're structuring somebody's finances and what they're trying to accomplish, being able to put those on a 30-year mortgage is going to be very beneficial for them on a month-to-month basis. A lot of times people, especially parents, are concerned about somebody taking a mortgage out on a 30-year continuously. One of the things that's happened recently, because we can be able to remove mortgage insurance because rates have dropped so much, there's been quite a few people that we've been able to take from a 30-year loan and put them on a 15-year or 20-year loan. In this situation with the individual that we helped get out of the FHA loan, their payment was actually increasing just a little bit by going to the 20-year loan. So they were able to put themselves in a better financial position by getting on a 20-year term. They were able to lower their rate, they were able to lower their total interest, and we were able to put them into a better financial position. We can be able to look at all of the scenarios and what you're trying to accomplish. A lot of times when people come and meet with me, they will tell me, I'd like to get a lower rate, I'd like to get a lower payment, and I'd like to be able to shorten my term if possible. That's always usually a secondary or tertiary goal with what we're trying to accomplish for them. So we start talking about what they're really trying to do. In some situations, they may not care about their lowering their payment as much because we may be paying other things off. And so we can be able to talk about the different scenarios and what works best for you. And most of the time, people will leave our offices very surprised at what we can be able to accomplish for them. All right. Is it expensive to do a Heloc? Are there fees? I don't do the Helocs. I do know at the credit union that we can be able to do Helocs without any fees under a certain dollar amount. I believe it's 250,000, but I need to have you talk to a Heloc specialist about that. Most of the Helocs, if they're below that, if not all of them, are not going to have any upfront fees. Same thing with our second mortgages. They are no fee products. They can have early closure fees and stuff like that, but we can talk more in detail about that. If you're worried about the cost of it and setting it up, there are typically no costs associated with that. Once again, I'd recommend that you give us a call. We can be able to talk about the specifics of what you're trying to accomplish, and we can be able to discuss those things. What is the process for validating a home value? That's an excellent question. So depending on the type of product that we're doing and what we're doing will determine what sort of appraisal is going to need to be done. Sometimes they're doing basically computer appraisals. Sometimes they do appraisals where they do the computer appraisal, but they want to take pictures inside. Sometimes the actual appraiser needs to come out to the home and verify the value of the home. Depending on the product that you're applying for is going to determine what sort of appraisal if it needs to be done. We have been seeing a lot more appraisal waivers on first mortgage refinances or purchases, whether it be a cash out refinance or a rate and term refinance. So that is something that is available at times. The computer is going to decide that. We are going to try and put you in the best position possible, but sometimes we won't know until you apply for the loan. Right now, the credit union, is it through the end of the year or through the? No, for the first mortgages that we're paying for appraisals.
Yeah, through the end of the year.
Through the end of the year, I know that we have a program right now with our first mortgages that we are paying for someone's appraisal up to $500. So it's an excellent way for us to be able to do a product for you. You do have to apply to be able to get that product. We're just not doing free appraisals for people, but it's one of those things that can be able to save up to $500. Sometimes people are concerned about what the cost is going to be. That's something that you don't need to worry about right now because we're picking up the tab on that. Do you need an appraisal for a refi? once again, we won't know that until the application is done. There are some times where we can estimate if we're going to need that or not, but it's not always the case. It's the computer's going to decide if we need to do a appraisal or not. There are certain things that will make it more likely that we won't need that, but we'll go through and we'll try every avenue we can to be able to not have that appraisal be done. It saves time, it saves money. There's just a lot of benefits of getting those appraisal waivers. The mortgage consultants try every avenue and take advantage of every option we can to be able to avoid having to do an appraisal. All right, another question. Is the underwriting documentation process similar for a first mortgage? That is an excellent question. It is very similar. With the guidelines are similar that we follow, that we go through to be able to get them taken care of. Mortgage consultants are fantastic about asking detailed questions and going through and finding out what type of income that you have, what kind of troubleshooting we might need to come up with to be able to get your loan approved. Within a 15-minute conversation, we can be able to find out exactly the documents we need to get you from point A, where you're at right now, where we're having a conversation, to point B to have your loan closed and the funds in your hands. So we'll go through all of that stuff with you to be able to talk about it. We do need to verify income. If we need assets for any reason, we'll need to verify those, but we can be able to go through it. Each loan is different, and so we need to find out what we need to verify on your particular loan. If you own multiple properties, it's going to be different than if you just own one property. So when we go through, we want to make sure that we're specifying our documentation request to your specific loan. All right, another question. Can I have my employer's payroll direct deposit directly into the Heloc without going through a checking account? That's an excellent question, Daniel. I do not have the answer to that. I'll be honest with you, I don't even know how to transfer money from savings to checking. I do mortgages here at the credit union, so I could be able to find that answer out for you. I'm more than happy to be able to get your email address and find out. I don't believe that you can be able to do that, but I could be wrong. So let me get the answer to that, and I can get in touch with you and give you a specific answer. So let me work on that for you, and then I can be able to find out. Any other questions that somebody may have? Okay, I'm going to go through the mortgage consultants that we have up here on the board and where they're located. We pretty much have them throughout the valley. If you have any questions and you want to contact any of us, you can call us on the phone number. It's 801-481-8840. That rings directly to the mortgage hotline. I don't believe that you have to go through a phone tree to be able to get us with that number. So you can be able to call that. One of the mortgage consultants will pick up. We can be able to have a conversation with you and talk to you about your needs. A lot of times right now, people are worried about meeting face-to-face because of COVID. We can be able to do everything online. Most of my members do everything online. It's extremely rare that I'm actually meeting with people right now. We've actually implemented some new processes at closing, so that closing at the title company, the county still requires some wet signatures on some documents, but that number has dropped probably from 20, 25 documents down to 3 or 4. So closings now are only taking 10, 15 minutes to be able to get those done. So we've really streamlined everything with what happened over the last 2 years and how we can be able to better fit your needs and what we're trying to accomplish. We are available from 9 to 6 is when the branches are open. I know that the mortgage consultant's cell phones are online. I tell all of my members that they're more than welcome to contact me from 7 a.m. to 10 p.m. 7 days a week. I know some of the other mortgage consultants' cell phones are available online. My members are more than welcome to be able to text me. We want to be as accessible as possible to be able to help you. And so if you need something, feel free to be able to reach out to us and we'll get you taken care of as soon as we can. All right, any last questions that we have? Okay, we will be reaching out to each one of you. We appreciate you setting up some time to be able to listen to me today. We'll be reaching out if you have any specific questions. Feel free to be able to give us a call or reach out to us when we email you. And we hope that we can be able to get your needs taken care of soon. Thanks so much. Have a good day.